If you have the appropriate perspective, you may find the great possibilities hidden in any economic crisis. The problem is that there are various viewpoints in economics, not a definitive good or bad. Booming markets are great for existing investors who want to see their portfolios grow, aren't they? Assets increase in value, money moves, and champagne corks erupt. However, what about the prospective investors who are watching from the sidelines? They have to scale a greater wall created by those growing prices in order to become members of the ownership club. And when the markets collapse, it raises the same question, but in reverse. Your experience of these economic waves is entirely reshaped by your circumstances. While most people fear market crashes, obsessing over lost wealth, declining company values, reduced consumer spending, potential bankruptcies, and job losses, the savvy investor recognizes these moments as rare opportunities. Market downturns allow you to acquire valuable assets at substantial discounts. I've lived this reality. The 2008 real estate crash wasn't just a crisis. It was a wealth-building opportunity that transformed my financial future. These moments don't just destroy wealth, they transfer it to those prepared to act. Financial success isn't always about working harder or even smarter. It is often about seeing opportunity where others see disaster. While most of the world freezes in fear or pulls away in moments of crisis, the wealthy seem to thrive. Is it luck? Not quite. It's strategy. Take the 2020 pandemic, for example. When markets crashed and fear ran rampant, many people panicked. They sold their stocks, abandoned their investments, and hoarded cash, waiting for the storm to pass. Others didn't. Instead, some people saw something else, a rare window to build wealth, a moment of unprecedented opportunity hidden in the chaos. Let me explain. With markets plummeting and economies stalled, you can see disaster if you want to be successful at this. Think of the opportunity as seeing discounts. Some of the best companies in the world were selling their stocks at fractions of their true value. Real estate loans faced opportunities for renegotiation, leading to incredible buying potential. While others were focused on survival, we were preparing to strike. I dove into research, pinpointing investments that were severely undervalued thanks to fear and uncertainty. Timing was everything. While many people were focused on protecting themselves from loss, I made calculated moves to acquire heavily discounted assets, stocks, ETFs, select businesses, all while keeping one eye on long-term trends and potential recovery. It wasn't easy or instant magic. It took guts, it took research, but most of all, it took preparedness. And the gains? They were astounding. Some of the positions I acquired during the pandemic downturn eventually delivered returns I could barely have imagined when the recovery kicked in. The value of these investments skyrocketed as businesses stabilized, government stimulus helped bolster the economy, and consumer confidence returned. By the time most people felt safe re-entering the market, the bargains had disappeared. But for some people, including myself, the foundation for success was already in place. What's the secret? I didn't wait for perfect conditions. I acted when conditions were bleak. This isn't some abstract financial advice from textbooks. This is a tried-and-true principle. Wealth building thrives in moments of adversity. Think about it. The greatest economic downturns in history have consistently created opportunities for those willing to seize them. Warren Buffett famously coined the idea, "Be fearful when others are greedy, and greedy when others are fearful." That single truth can transform how you approach your financial future. Now, it's important to acknowledge that this kind of strategy makes people uncomfortable. Why? Because it feels insensitive. The idea of benefiting from a crisis seems, at first glance, morally ambiguous. But let me challenge that notion. The opportunities created during recessions, pandemics, or other hardships don't take anything away from anyone. They exist in the natural push and pull of economics. The way you approach them defines your ability to uplift yourself, and perhaps future generations too. What's more, building wealth during downturns often leads to reinvestments back into an economy that needs revitalization. Real estate investments can turn abandoned spaces into thriving neighborhoods. Stock acquisitions help inject capital into companies struggling to survive. The idea isn't about exploitation, it's about strategy and resilience. So, what does this mean for you? It means preparation has to come first. The people who succeed during tumultuous times aren't lucky. They're ready. They've done the research, allocated their resources, and trained themselves to act decisively when markets falter. You can't control when the next downturn will hit. You can't control the scope or shape of the crisis. But what you can control is your mindset and your ability to recognize opportunity, even when everyone else seems focused entirely on the disaster. The next time downturns dominate the headlines, take a step back. Ask yourself two questions. Where is the fear driving irrational behavior? And where is value being overlooked as a result? Those principles are key to spotting the investments that will grow exponentially once the dust settles. And don't forget, preparation isn't just about identifying opportunities, it's about positioning yourself to act on them. This could mean setting aside funds for a rainy day, building strong financial literacy, or training yourself to act with calm and reason rather than emotion. When the time comes to strike, hesitation will cost more than anything else. As I reflect back on the lessons of 2020, my financial success didn't come from perfection or luck. It came from confidence and preparation. It came from turning adversity into triumph and seeing the patterns that others ignored. And it's a lesson that will stick with me forever. When disaster strikes, opportunity is always close behind. The question is, will you be ready for it? The next downturn is coming, whether next year or a decade down the road. The world will panic. Fear will dominate headlines. But the few who stay calm, see the bigger picture, and act decisively, they'll succeed. They always do. Recessions, those moments that make stock market indexes plunge, wallets tighten, and businesses scramble to survive. This is also a time when many people get angry. For many participants in the economy, recessions are storms to weather, a period of uncertainty and loss. But for others, they are moments of opportunity. While the popular narrative often focuses on the pain caused by economic downturns, the reality is that recessions don't treat everyone equally. They create winners and losers, and the design of our economic systems determines who falls into which category. Let's dive into the underlying mechanics of why this happens, using the American capitalist system as an example. At its core, capitalism rewards adaptability, efficiency, and the ability to meet changing consumer demand. When the economy contracts and uncertainty rises, these priorities are amplified. Companies and industries that are well positioned to exploit the new environment often emerge stronger, while others are left struggling, or even shuttered entirely. Take, for instance, the 2008 financial crisis. At the time, traditional retail chains like Sears, Macy's, and J.C. Penney were already showing signs of weakness. The recession accelerated these weaknesses as consumers became increasingly budget conscious and moved away from the department store model. On the other hand, discount retailers like Walmart thrived. Why? Because Walmart had structured its business around affordability and efficiency. When household budgets tightened, Walmart became the go-to destination for consumers looking to get more for less. Similarly, Amazon leveraged the same recession to cement its dominance in e-commerce. With brick-and-mortar stores struggling to get foot traffic and consumers looking for cheaper, more convenient options, Amazon grew its footprint, not only in retail, but also in cloud computing, as businesses scrambled to cut costs and move operations online. If you had invested in Walmart or Amazon stock during the downturn, you'd likely have seen monumental returns in the years to follow. But winners in recessions don't always come from the bargain aisle. Surprisingly, luxury brands tend to hold up better than most industries during economic downturns. How is that possible? It comes down to their customer base. High-end companies like Louis Vuitton, Hermès, or Chanel cater to the wealthy, a demographic less affected by economic contractions. While middle and lower-income households need to cut back on spending, upper-income consumers often maintain their purchasing habits, ensuring luxury brands remain insulated from the broader pain. Now, let's fast forward to the COVID-19 pandemic, another recessionary event with its own winners and losers. While airlines, restaurants, and tourism companies plummeted into survival mode, tech companies exploded onto the scene. Zoom became a household name overnight, capitalizing on the sudden need for remote work capabilities. Tesla saw its stock skyrocket, buoyed by the increasing investor enthusiasm for innovative and environmentally focused businesses. And companies like Peloton thrived as quarantine consumers embraced the convenience of at-home exercise. Meanwhile, challengers in traditional industries continued to lose ground. Airlines like Delta and American were forced to take on significant debt to stay afloat, while energy companies reliant on oil prices took a massive hit. The gap between the winners and losers widened further as big tech gained increasing dominance over global markets. Now notice that I have given an example of the pandemic recession already. I am bringing it up again because I am trying to drive a point here, and I want to make sure you truly get what I am saying. But let's dig deeper. What drives these outcomes in a recession? It comes down to a combination of consumer behavior and structural advantages. Companies with strong balance sheets, diversified revenue streams, or products that align with shifting priorities are better equipped to weather storms. For example, when unemployment rises, consumer spending naturally shifts towards necessities like groceries and utilities. That puts companies like Procter & Gamble in a favorable position. In contrast, businesses offering non-essential goods or relying heavily on discretionary spending, like entertainment or travel, are far more vulnerable. And this disparity in resilience reflects a larger theme of inequality inherent in capitalist economic systems. Just as recessions magnify disparities between households, with wealthy families often better able to absorb shocks, they also amplify disparities between businesses. Market leaders with access to capital can take advantage of weakened competition by investing, acquiring smaller firms, or expanding market share during downturns. For smaller, less established players, those same conditions are often fatal. Investors also play a crucial role in shaping the dynamics of winners and losers. During recessions, capital flows towards assets perceived as safe bets. While companies with high debt or shaky fundamentals struggle to raise funds, giants like Apple or Google become even more powerful due to investor confidence. In markets where stock prices fall dramatically, companies with strong fundamentals often emerge relatively unscathed, or even better positioned to thrive post-recession. This brings us back to the design of the system. Capitalism is not built to distribute losses evenly. Instead, recessions become stress tests, illuminating the advantages of some and the vulnerabilities of others. Whether it's Walmart versus Sears, Amazon versus brick-and-mortar stores, or Zoom versus traditional office infrastructure, the winners and losers from a recession are often preordained by the system's rules. Now, let's bring this home. First, recessions offer lessons about resilience, whether it's for companies, for individuals, or for investors. Understanding the forces that create winners and losers can help you better prepare for downturns and identify opportunities that might otherwise be invisible. Second, we must also confront the long-term inequalities built into economic systems. As recessions consistently reward the strong and punish the weak, is it possible to reimagine systems that create broader accessibility to opportunity, even in times of crisis? After all, every storm eventually clears, but who rebuilds first depends on the design of the economy itself. Here's the thing, if you don't grasp how our economic system functions, you're essentially playing chess without knowing the rules, perpetually in check. Think about it. Most of us graduate without a single lesson on how money actually works. So there you are, degree in hand, climbing the career ladder, completely in the dark about the mechanics that keep wealthy people accumulating more wealth. No wonder you're frustrated. It's like being angry at a game whose rules were deliberately kept secret from you. Master the system, and you'll unlock its benefits for yourself. Consider this. When government officials announce a new spending program, the true impact isn't universally good or bad, it's situational. For those positioned to receive these funds, what others might debate in the abstract becomes your concrete financial advantage. Wouldn't you rather be on the receiving end of that equation? While those checks putting money in your pocket might seem like pure good news, don't overlook who ultimately pays you through rising inflation and increasing taxes. This hidden financial reality is precisely why you need market briefs. Can you really afford not to understand these forces shaping your financial future? Make no mistake, our world divides into winners and losers, but you can choose which side you'll be on. The secret? Mastering our economic system. Every single economic decision creates opportunity for someone while leaving others behind. If you truly want to secure your future, protect your family, and strengthen your community, you must first understand this fundamental truth. More importantly, you need to develop the crucial skill of opportunity recognition. When others see disaster, winners see potential. The most successful people don't just weather economic storms, they harness them. Will you develop the vision to spot these opportunities when others can't? When the world descends into panic selling, that's precisely when your greatest opportunities emerge. History has repeatedly shown that those who dare to move against the frightened herd, deliberately acquiring oversold assets while others desperately exit, position themselves for substantial profits. This isn't speculation. It's a proven financial pattern that rewards the courageous contrarian. Don't follow the masses into fear-based decisions. Recognize these market dislocations for what they truly are: rare wealth-building opportunities. So how can you apply this strategy? Look for companies with strong balance sheets, low debt, and consistent demand for their products, essentials that won't fade even during tough times. Think tech, healthcare, and utilities. When the market punishes them unfairly, you have a chance to buy the future at a discount. Next, real estate. Recessions often lead to a correction in real estate prices, and while many shy away due to fear, savvy investors see opportunity. In 2010, during the aftermath of the housing bubble, investors bought homes at a fraction of their previous value. This allowed many to not only profit from price appreciation during recovery, but also to generate stable rental income while waiting for the market to bounce back. This works best if you approach it strategically. Look for properties in growing areas or regions with strong job markets and infrastructure projects in the pipeline. Using tools like FHA loans or investing through real estate investment trusts, REITs, can make entering the market less intimidating, even if you don't have a huge pile of cash to start with. Speaking of REITs, this is an excellent avenue for those who aren't ready to buy property directly. REITs allow you to invest in portfolios of properties, commercial real estate, apartments, or healthcare facilities, and during recessions, many REIT prices drop, again giving you a chance to scoop them up at a discount. Now here's another overlooked strategy. Invest in commodities, like gold and silver. Historically, precious metals have been a safe haven during uncertain times. When economies falter and currencies weaken, people turn to commodities to preserve value. In 2008, as stock markets collapsed, gold nearly doubled in value within 2 years. On a more modern note, take the example of energy companies. In recessions, energy prices sometimes dip, making it another prime time to invest. Demand for energy doesn't stop, it only pauses, and as recovery kicks in, these sectors often soar. To bring this closer to home, you might consider pairing commodities with something even more resilient: yourself. Investing in your skills during a downturn might not make you millions immediately, but it can prepare you to ride the wave upward once prosperity returns. Learning about new trading strategies, acquiring financial analysis skills, or even understanding cryptocurrency markets could put you miles ahead by leveraging the gained knowledge when conditions stabilize. Let's also touch on a slightly more advanced strategy: index funds and ETFs. These tools allow you to bet on the overall recovery of the market without worrying about picking the right individual stocks. During the Great Recession, the S&P 500 lost over 50% of its value, but over the next decade, it gained over 400%. Those who strategically bought into index funds during the downturn were rewarded handsomely when markets recovered. And finally, diversify. This is the golden rule to protect your downside during a recession while maximizing your upside potential. Bonds, dividend-paying stocks, and even a mix of international investments can cushion your portfolio against shocks while keeping you primed for long-term gains. So, what's the takeaway here? Recessions aren't something to fear. They're something to prepare for. The people who build wealth in these times aren't necessarily the richest or the smartest. They are the ones who are ready. When emotions are running high, risks will feel intimidating. But history proves that the greatest opportunities come when others are retreating. Take calculated risks, do your research, diversify thoughtfully, and most of all, remember this: recessions don't last forever, but the wealth you build during them just might. Thanks for watching. Until next time.